Good evening, everyone, and welcome to Bank of Baroda's financial results for the fourth quarter of FY2024. Welcome to the analyst meet. We have with us Shri Devdutt Chand, the MD and CEO, and he's joined by the bank's executive directors and the CFO. We have a short presentation for you, followed by opening remarks by Chand sir, followed by the Q&A session. Chand sir, over to you.
So thanks, Firoja. So to introduce the management team, I'm D. Chand, MD and CEO, and I've been interacting with you for a couple of quarters now. And with me, Mr. Lalit Tyagi, he's the Executive Director. He looks after corporate credit, international and treasury, apart from a couple of other departments. We have with us also Mr. Sanjay Mudaliar. He's joining for the first time in terms of analyst meet. He is Executive Director looking after the digital side. And also importantly, he's the retail face of the bank in terms of looking after both retail asset and retail liability. And we have with us Mr. Lal Singh. He has been there for at least a quarter now for interacting. Mr. Lal Singh is looking after the recovery more importantly, and also the priority sector department like MSME and Agri. And as you know, we have with Mr. Yan D'Souza, he's the CFO of the bank. So with this, over to you, Yan. You can make a presentation, and thereafter I will give some comments on that. Please.
Can we put up a presentation, please, and we can go ahead?
Yes, doing that.
Good afternoon, everybody. Very nice to see all of you all once again, and to bring to you some highlights of our results that we just declared. So one of the top line numbers that we declared today as of March is a 24 trillion benchmark we have crossed for the first time in terms of our total business. And we have retained our pole position as one of the second largest public sector banks. In terms of growth and advances, we have given you guidance that we will be growing around 13%. We are very near that mark at 12.5% year-on-year growth in global advances. In terms of our stated aspiration to grow our RAM book, we are growing excellently well in retail at close to 21%. In MSME and Agri, we continue to grow at around 12%. Corporate, we had been growing at a faster pace earlier. We have consciously taken a call to grow at a lower rate. In terms of within the retail portfolio, home loan is printing at close to 14.5%. Education is around 19%. And auto loan is around 23.8%. We had given guidance in earlier quarters that we would moderate the growth of our personal loan. So last financial year, our personal loan portfolio grew close to 100%. We had moderated it sequentially down to 60% last quarter, year-on-year. This time it's printing at 52% almost year-on-year. So this is a portfolio which we will continue to focus on, but we will not grow it that aggressively. In terms of deposits, can you go to the next slide, Global? In terms of deposit, we are giving guidance of around 12%. Our deposit growth has been a little muted, but this is a number that we will be focusing on in the coming quarters to get it up in a trajectory. In terms of CASA, sequentially our CASA grew at 7.5%, though year-on-year it has grown at around 5.5%. But this is a little ahead of the peer group that we have been seeing the results coming out in the last few days. In terms of CD ratio, this is a ratio we are conscious of needing to manage, and we have reduced our CD ratio by 200 basis points sequential quarter-wise. Our CASA ratio has improved sequentially by 64 basis points. Please go ahead. Operating profit has grown above 15%. Profit after tax has grown more than 26%. ROA, we've been delivering 1% plus ROAs for 7 quarters now. And this quarter we have delivered ROA at around 1.25, and for the full financial year it's 1.17. This is the second financial year we have delivered a 1% plus ROA. In terms of ROE, we are close to 19%. Please go ahead. In terms of yield on advances, our yield on advances grew almost 100 basis points year-on-year. there has been pressure on our deposit cost as the liquidity scenario has remained tight. So we've seen almost 100 basis point increase in deposit costs as well. Our NIM for the quarter has printed very smartly at 3.27. However, I'd like to call out here that there have been some seasonal effect here of the year-end recoveries. And if we had to exclude the seasonal effect of higher than expected year-end recoveries, our 3.27 would print at close to 3.15 for the quarter. And our full year, excluding the exceptional recoveries we had in the last year, instead of printing at 3.18, would print at around 3.14. So we have, even on a normalized basis, normalizing for excess one-offs, we would have achieved our guidance of around 3.15 for full year NIM. Please go ahead. In terms of asset quality metrics, you see our asset quality improving year on year. GNPA is below 3% and NPA is well below 1% at 0.68. Provision coverage ratio is very comfortable at 93.3%, including TWO. Slippage has been below our guidance of 1 to 1.25. It's been at the lower end of the range. I'd like to draw your attention, though it is below our range of 1 to 1.25. There were two large slippages during the course of the year, and even after that, this has been below 1%. So there was the aviation account, which was 1,700, and an international account of 500 crores. So on account of these two accounts, there was a slippage of 2,200. Despite that, we have delivered as per our guidance. In terms of credit cost, I think this is a number that is optically a bit high because we had taken a conscious call to provide for the aviation account slippage. Earlier, till quarter 3, we had provided around 1,200 crores on the aviation account, and this quarter we have provided a further 550 crores. So essentially, we provided 100% on the aviation account in this financial year, whereas we were required, as per our policy, to provide around 20%. If we had provided around 20%, that would have been a provision of just around 500 crores. So essentially, we provided around 1,200 crores more on the aviation account, plus a floating provision we had taken in the June quarter of 200 crores. If you exclude for that, our credit cost would be in line with the previous year's credit cost. Please go ahead. So in terms of our CRILIC SMA 1 and 2, you would see this number has been trending down continuously. At this moment in time, it is just 0.15, which indicates a very strong asset quality, as there's nothing that is on the radar in terms of large exposures as being non-current. In terms of collection efficiency, we continue to print strongly at 98%. Please go ahead. In terms of our capital adequacy, as you are aware, there were the RBI guidelines which actually required banks to provide higher risk weights on certain NBFC and unsecured loans. That actually would have has pulled down our capital adequacy by around 65 basis points, and we had called that out in the earlier call last quarter. Despite that, our capital adequacy has printed at a level which is higher than the last year capital adequacy, solely on the basis of internal accruals. We've done bond raising, but the bond raising has only been to the extent to replace maturing bonds. So this is entirely organic replacement of capital. And our CET1 is also very smartly at 12.54. Our LCR remains at close to 121% as of March 24. With that, I come to the end of my presentation. Back to you, sir, for your remarks.
Thanks, Ian. Again, good evening to all of you, and let me make a couple of comments. This year or the quarter performance has three strong outcomes. One is that we do have a robust book growth, and this book growth is calibrated to the growth in deposit, because earlier we said that we want to reduce our dependency on wholesale deposit. So calibrating the growth of deposit, the advance book has been almost at 13%, 12.5%. The domestic advance growth is at 12.9%. And the important part is that earlier also we said that the international book will moderate. We have moderated to 10.5% as compared to a 40% increase earlier. So considering that, it's a robust growth in terms of book, calibrating to the growth in deposit. The second aspect which is important out of this financial is that we do have a very strong financial performance. The book is growing at 12.5-13%, wherein the operating profit has gone up by 15.1%. The net profit has gone up by 26%. So there is a strong financial as far as this year financial performance FY2023-24 is concerned. The third thing which is important is a much better asset quality. Why it is important that we have seen there is a significant improvement in all parameters as far as the asset quality. Please be also take a note that as far as asset quality, the earlier position also we are benchmarked to some of the best in the banks in the entire industry. At the same position also we have reduced both GNPA and NPA. So specific comments then I have apart from these three important aspect that I talked about. We have achieved a significant milestone this financial year. That's that in terms of scale, the total business we have exceeded 24 trillion in this financial year ending March 24. So that's a very significant scale in terms of the space we operate in terms of PSU. Our retail advances also this year crossed 2 lakh crore, which is again retail has been growing almost more than 20% for last many quarters now. And earlier also we talked to all of you that we want to slightly push for our retailizing our book. So in line of that, the retail growth has been very strong. Our net interest income has exceeded 44,000 crore for the first time, and that gives a growth of around 8.5%. There is a bit of squeeze because of the cost pressure they are in. The operating profit exceeded 30,000 crore for the first time, and that's something I already talked about, a growth of 15.3%. The operating profit growth has also supported by a very strong and sustained focus on the non-interest income. And if you look at the non-interest income for this year vis-a-vis last year, the growth is almost 40.7%. From 10,000 crore to it has gone up to 14,495 crore. It is coming mainly for two subheads. One is with regard to the CEB, the commission exchange brokerage, where the growth is also 19.9%, whereas the treasury income has been almost at 40%. So consequently, all these what I highlighted, the net profit has seen an increase of 26.1%, which is a 17,789 crore as compared to 14,410 crore last year. And here a couple of comments I would like to give that for last 5 quarters, including March 24, we have been posting profit in excess of 4,000 crore. In terms of a run rate, if I said that this year profit is almost 123% of the last year profit. So a couple of guidance that we'll all like to be interested to know for FY24-25. We are expecting the outlook that we see as in today. We are expecting a deposit growth between 10 to 12%. With a focus on CASA and the retail term deposit. On the advance growth, we are looking at 12 to 14%, with a focus on retailizing the book more, which retail as such growing at more than 20%, with the corporate growing almost at 11 to 12%. The NIM guidance, as Ian already said, if you look at the full year NIM, it is at 3.18. Rather, the sequential growth in the NIM has been better because we last time discussed with regard to the dip in the NIM on December quarter, but we have improved that for this quarter. And on a normalized basis also, it is higher than that of the last quarter, that is, I'm talking about the December quarter. And the full year NIM is almost at 3.18. So we are maintaining our guidance of NIM at 3.15 plus minus 5 BPS. But as the market outlook would change, then we'll just see going forward whether we need to revise the guidance, but we hold for a full year guidance of 3.15 plus minus 5 BPS. The ROA has been consistently for last 7 quarters more than 1. And earlier we had given a guidance of ROA in excess of 1, but we are revising upward the guidance from 1 to 1.10. So considering the strong profit matrix we do have, we are fairly confident that we'll achieve a full year ROA of 1.10. The slippage ratio continue to have the same guidance of 1 to 1.25. So we are preparing ourselves for all scenario going forward. So although the slippage for this year has been less than 1, but we are maintaining the guidance at 1 to 1.25. The credit cost continue to be, it is already less than 1, continue to have the same guidance of less than 1. Now on the asset quality, I would like to highlight that apart from the reduction in GNPA and net NPA, Typically you all look at the portfolio at risk or the book at risk, and that typically if I take the SMA 1 and 2 of the pre-league plus the restructured standard book, in terms of percentage to the outstanding standard advances, which was at 2.04% as on March 23, has gone down to 0.92. So not only on the GNPA, net NPA, we have seen significant improvement, but also the portfolio which can be at risk also has gone down significantly. So going forward, the outlook is much better as far as the asset quality is concerned. So these are a couple of points that I wanted to highlight. And we are fairly confident that the bank has a strong, robust business model and will continue to sustain that going forward. With this, I open for question and answer. Over to you, Firoza.
Thank you, sir. We'll now open it up for question and answer. The first question is from Ashok Ajmera. So if you can unmute yourself and ask your question, please.
Yeah, I got the unmute sign just now only, so there was a delay.
Yeah, please go ahead.
Good evening, all of you, and Chan Sahab.
Good evening.
Definitely, the results are very good. Overall performance of the bank on all the parameters is really, I mean, on some of the parameters, it is more than what was expected. Having said that, sir, I have got a couple of point of informations and some concerns on that slippages and the provisions. So some, like you see this, our provision on this aviation account, 1,750 crore was the total, I think, approximately outstanding. And you said 1,200 crore was already provided for, and now 550 crore has been provided now. And that is why our provisioning is little higher. But sir, here I feel that we had some major collateral security also from this account. So number one, yes, it is as a prudent measure, it's really good that you provide it for fully. But when do you expect the recovery to come, if not from the main account, at least from this collateral? Because only I think two banks are only mainly are there. I think you and Central Bank, if I'm not wrong, or maybe. So, so can we expect some major recovery from those collateral securities on this? This is just my first question, sir. I will come back. I am on the line.
Okay. If I respond to that, as you said rightly, the account is now 100% provided. In terms of the recoverability out of this account, earlier also we said that we have a very high, what you can say, expectation of recovering the amount in full. Why? Because apart from the primary, we said earlier, the account is heavily collateralized. 1/3 of the exposure is government guaranteed, and the balance also, if you look at the collateral value, it's covered as on today, including a bit of leftover primary. So we are hopeful, like if you look at this account, the upside is there for the subsequent years out of this account. In terms of timelines, there are two litigation process, the legal process going on. One is with regard to the Delhi High Court that you have already seen that, and the second is with regard to the NCLT process. NCLT process now, the CIRP date has been extended by another 2 months. So these are all legal processes where it has its own time to consume and get a recovery. We expect it to be done at the earliest, but then again will be depending on the legal process to get recovery. But as far as the upside is concerned, the entire upside is there with us, and we expect also, I mean, full or maximum recovery out of the account as you stand now. So, Mr. Lal Singh, anything further you want to add on this?
No, sir, it's okay, sir.
Okay, sir. So,
sir,
okay,
my second question is, sir, on a very talked about subject of recent guidance note by RBI for higher provisioning on the project loans of 5% going forward in next 2 or 3 years. We had a very detailed discussion yesterday in State Bank of India also on this, because you come, I mean, next to SBI. And there they said that out of our total, you know, on book, it looks 450,000 crore total infra and everything. The project loan which might come under the purview of this guidance note maybe only 1.5 lakh or something, or 1.4 lakh or something. And in that also there are ifs and buts, and there is no full clarity. So in our case, as a ballpark figure, out of your total portfolio, how much portfolio do you think can come under the purview if this guidelines is implemented as it is? And what are the other finer points? Have you done some calculation that how much need to be provided for or in next 2-3 years for us, and whether it is under control, manageable, we are comfortable, or yes, there is some concern on the capital adequacy also later going on that.
Yeah, Ajula sir, actually you are fairly right, but there are two, you'll be excusing me for that. Actually, as far as this particular circular or this is concerned, this is a draft guidelines as part of the consultative process. So there is no finality. So our corporate policy is to not to have views with regard to a draft guidelines and consultative process. So that's why I'll not in a position to tell you with regard to the outstanding book. But as far as the impact is concerned, as on today, what we see out of this is that there are two things that a bank typically can do. One is with regard to, in case you have huge capacity, you can absorb the cost. Otherwise, you can pass on. So we as an intermediary obviously would like to pass on that impact. So even if on an impact scale, I don't think the credit cost would go up significantly. It can be a couple of percentage point, less than 10 bps for the matter. So, but as on today, on a corporate policy, we are not commenting on a draft guidelines because that is what we believe not fair at this stage, because the guidelines has not been issued. It is only a consultative. The final circular can be different than the original, or we do not know about that. So that's why we are not commenting. Mr. Tyagi, anything further on that?
No, sir, you said it all. I would say that since these are the draft guidelines and consultations are there, RBI in fact has also solicited the views of the stakeholders. And these guidelines are getting evaluated at our end, also at the industry level. And I would urge to have the little bit more time to, clarity to emerge. As far as the impact is concerned, I'm sorry.
Yeah, no problem. I mean, impact you said will not be more than 10 basis or 15 basis point. That's okay. Point well taken, sir. Sir, my last question in this round, if and otherwise time permits, I may ask some more, is on our other income other than interest income. There we have performed very well on the treasury front, you said. So one is that. And another one is, sir, there is one other income without any explanation of 313 crore in this quarter. Can I have some color on that, some information on that, the 313 crore? And going forward in treasury, now with some signs of rate might, because our AFS book is also good. So some color on the treasury, and similarly in the return of account also the recovery this quarter has been very handsome, 1,202 crore as compared to 847 crores. So on these three covering, all these three other income and can you just comment on that, sir?
Yeah, on the treasury, I comment and leave it to Ian and Lalsingji to address the remaining two. Treasury, as you said, that two things contributed. One is a higher trading profit this year as compared to last year. Secondly, last year there was a depreciation in the book, whereas this year there is a write back to the extent of 489 crore. So that has contributed in terms of non-interest. But nevertheless, we also said earlier, we strongly, running a drive for fee and flow within the bank. So we'll be augmenting the CEB, the Commission Exchange Brokerage, going forward, and that going to be it's a sustained efforts and focus to improve the fee income and also the non-interest income. Going forward, as you know, you are also part of Treasury. There is a change circular now, right? So in the change circular, the trading profit won't be to the extent that we booked last year, because we are not going to have the AFS profit getting into the profit and loss, right? So there may be a dip in the trading profit going forward, but one thing is very clear, that the interest income on investment would go up significantly, and that would compensate to a very large extent the dip in trading profit. So that's something again is and the new circular is quite positive on the capital front, right? So that would go to reserve, and that's something very positive on the capital front. So this all sum up to will be in a position to optimize on all the front, so as to maintain the profitability, income earning potential, contribution to the capital out of treasury book. So that is what we believe is going to happen for next year. On the interest rate also, I do believe things although may be elevated for a longer time, but then there is a moderation expected maybe in Q2 or Q3, and that may give some further upside to the profit side, right? So on the on the 313 crore, you just take that call, and the return, the profit on the return of accounts, possibly also can contribute. Yeah.
Yes, sir. So the other income, is actually interest we have received on an income tax refund. So since the time has elapsed, since the refund was due to us, we received interest on it. So this is more like a one-off. It is not sequentially repeatable, but it can come in future as well.
So Lal Singh sir, on the recovery on return of accounts, can you give some color?
Yeah. So the recovery in the return of account in 24-25 is also expected to be sustainable on the same basis last year. Last year we did 5,098 crores, and this year also we expect the similar recoveries in this portfolio. We have the portfolio of around 46,000 crores, so we expect this much of recovery.
Okay.
Thank you, sir. The next question is from Kunal Shah. Kunal, you can please unmute yourself and ask your question.
Yeah, good afternoon. So firstly, with respect to yields and more so domestic yield on advances, no doubt you highlighted the impact of recoveries to be 5 bips on the overall NIMs. So that would be translating to say 7 odd bips on the domestic yields. But besides that, also there is quite a significant expansion in the yields, even after growing the corporate substantially on a quarter-on-quarter basis. So what would have led to that? So is there a repricing or some other element as well in the yields?
Yeah, that's a fair thing. If you look at the EBLR or the BRLR, which is repo linked, that is already done. So there is no upside in that book for last many quarters now. Whereas MCLR, it moves along with the cost of deposit, and if you look at from many months now, often when we are increasing the MCLR, the pricing on the MCLR, that is one. Secondly, we also said last time that when we announced the June quarter, saying that there is a bit of upside left with regard to the repricing of the MCLR book, because then normally if it is a 1 year MCLR, only you can reprice the revised MCLR after 1 year. So that's upside was also available, leading to a good growth in the yield of advances in that way.
Okay.
Anything, Ian, any further to add to this?
I think it's perfectly called out, because for us, actually, it works in two ways, right? Because when the repo rate was going upward, because of a smaller share of retail advances, we got lesser benefit. But when the repo rate is stabilized and it perhaps policy rates could come down in future, we actually ring fence to that extent, because 50% of our domestic book is on MCLR. So we will be to that extent protected, because that would take longer to come off. Yes. So that's something just to keep in mind when you're running your models.
Sure. And secondly, when we look at it in terms of the provision on employees, so that at least on a sequential basis, that number seems to be high compared to 800 crores kind of a run rate. It is like 1600 crores, while we were well provided on the wage revision and the related cost. So what is this element of incremental?
Yeah, so let me just take that one, Kunal. So essentially, if you recall in our previous calls, we had guided that once the wage settlement details are out, we could potentially have a 400 crore impact on account of retirees. So essentially, that guidance has played out, and there is a 400 crore impact. However, what we could not foresee that bond yields would fall at the end of March, and as a result, the discount rate has come down sharply. So the discount rate has contributed to another 400 crore impact. But this 400 crore impact is on account of the discount rate is unlikely to repeat, and with bond yields hardening, you could see some reversal of the second tranche of 400 crores. But these are more one-time hits. These are not to be built in on a sequential impact going forward.
Okay. So, yeah. So 400 is on that count.
No, totally 800. Totally 800, because you would see 812 in quarter 3 has doubled to 1600.
Yeah.
The one-time impact of 800 in two components.
Okay, got it. And one last question with respect to the GNPA is on PL. So that is now almost 1.95, and that too on a growing book at 50% on a year-on-year basis. So slightly on a leg book, it seems to be quite higher. So how we are, maybe at least in terms of the pricing and how protected we are with respect to the credit cost on that front, yeah. So even though a small component, but yeah.
Yeah, as you said, right, the book is small and 1.9% GNPA, but we are also looking at more importantly the collection efficiency and also the slippage part of the PL book. And these are all within the threshold in terms of the slippage, so absolutely no concern at this stage with regard to any stress book building up in the PL book. Secondly, there are two things we did vis-a-vis the last book that we had discussed on this. One is we said we are going to moderate, and we have clearly moderated because the moderation started in December and March quarter. If you run 2 more quarters, the growth would come almost at a 30-35% as compared to almost 80%, 100% earlier. Secondly, in the meantime, also we strengthen our underwriting model by taking a lot of advice from many of the rating agency, consultant and bureaus out of it. So the underwriting model is much stronger. This is on a backdrop of two facts which you need to account. One, that almost all are my existing customer and they are already availing one loan apart from this loan. And conduct of all these loans are fairly good. So I do not think any concern or alert at this stage with regard to that. But then some of the aspects that we are raising we are mindful of and almost already curated that book in that way. So there is no elevated risk out of the portfolio at this stage. They are all within the normal norms. Mr. Murziar, anything you want to supplement on this?
No, sir, I think you have covered it all.
Yeah, fair.
Next question is from Rikin Shah. Please unmute yourself and ask the question.
Yeah, thank you for the opportunity. I have a few questions. First one is on international deposits. So that has been growing quite rapidly at north of 25% YOY. So if you could explain a bit more what is the nature of these deposits, who are we getting it from, etc. So that's the first one. The second one is on the fee income. Of course, the focus on flow is translating into decent commission exchange brokerage, but it has been a bit volatile in terms of the QOQ trends, right? So the full year fee-based income has grown at 16%. How would you expect this fee income growth in FY25 is the second question. The third one is on asset quality. So the MSME slippages have also inched up in this quarter. Is there a common trend or any color that you could provide on the MSME slippage? And further to the question on personal loans, if you could just give more details about the yields that we charge, average ticket size, and the credit bureau score of our customers, that would be helpful. And the final question is a data keeping one. If you could just help quantify what is the outstanding quantum of restructured loan book for us. I think it was 9,900 crore in the previous quarter. What is that number now? Thank you.
So on the international thing, Mr. Tyagi would supplement me later. Actually, it's something to fund the asset growth internationally and also do bit of treasury operation therein, right? So treasury operation typically where you can optimize your investment and the return. So these are typically leading to slightly higher growth. This is one. Mr. Tyagi, you can supplement later. On the fee side, I think it's sustainable because we have created a relationship vertical that was fully stabilized across the bank, particularly for mid-corporate and large corporate in last year. And they are looking at share of wallet, they are doing account planning, they are one-to-one relationship manager with the customer. Whenever they talk with this customer, they are talking about all sides of the relationship. I think because we have made structural changes and this outcome, I think this is sustainable. Rather, we'll optimize beyond 16% as far as the growth in the future years concerned. On the asset quality, MSME, obviously MSME, the class is different than other. Like we had seen a corporate slippage legacy some time back, but MSME was going. COVID impact was maximum on the MSME. Rather, the MSME, if you look at the GNPA on the COVID time was much higher. It has gone down significantly, aligning towards the median average. The slippage slightly marginally above our normal slippage ratio of 0.99, but then again we are at the control of that. But also there are two things which are again supporting for a growth in MSME. One is with regard to these are accounts highly collateralized as compared to a normal corporate account one. Secondly, the yield on these accounts are much higher as compared to a normal corporate. So in terms of a trade-off vis-a-vis the pricing and I think these are all within the tolerance for us to grow at the same level going forward. So I don't think anything further concern on this. On the personal loan, as I said, a couple of details you asked for, but I'll leave it to Mr. Mudliar whether he has the data ready, but otherwise you can supply you offline. On with regard to the outstanding restructured book also, it has gone down. Mr. Lal Singh, you can tell on the outstanding restructured book. So on the international deposit, anything, Tegesa, we want to supplement?
So, sir, you have already said the broad aspect. The little bit which I can add is that in international, the deposit trails the advances. The more we grow the advances book, we raise the deposit. Sometimes we also raise the deposits for our market making as well as into the investments. And there are various avenues, so such as customer deposit, institutional deposits, etc. And whatever markets offers us the better opportunities, bank raises them and then deploy them accordingly. So that is one of the reasons for the faster growth of the deposit than the advances.
I can add also one point here. My investment on international has grown up almost by 1,500 crore. And all said and done, the inflation levels are almost same and the yields are much higher. Even almost comparable with the domestic yield as far as the investment goes overseas. So these are all treasury operations just to optimize on the yield side. So on the MSME asset quality, anything further, Lal Singh sir, we want to supplement?
Yeah. So as far as asset quality is concerned, the slippage ratio quarter on quarter, last quarter it was 2.57%. It's come down to 2.04%. And the recovery also is robust in the NP recovery in MSME book is 2,655 crore in this. And as far as the restructured book is concerned, that book has reduced to 8,148 crore now.
Yeah. So that's okay. On the personal loan, Mr. Mudliar, anything you want to supplement?
Sir, we will provide the relevant data offline to them.
Okay, fine. Thank you.
The next question is from Nitin Agarwal. Please unmute yourself and ask the question.
Yeah, hi. Am I audible?
You are audible, Mr. Please go ahead.
Hi, good evening, sir, and thanks for the opportunity. So a couple of questions. One is on the liquidity coverage ratio, which has seen a sharp fall this quarter while we had a very strong deposit growth. So what has really driven this fall in the LCR ratio?
Okay. So LCR, you know, it's managing actually required to have more than 100%, but we used to maintain at 135%, taking the global and domestic together. So a bit of that change happened because of we want to realign some of the asset both on the international and also on the domestic side, but still at 120 is healthy. And as far as the normal stance is concerned, we continue to maintain at 120 and above going forward. So in that way, there is a good coverage in terms of the LCR coverage going forward, right?
Right. And so second is on the CD ratio. So what is our domestic CD ratio now? And while we are looking to grow higher in terms of loan growth versus deposit growth next year, what will be a comfortable CD ratio range that we would look to maintain?
Okay, that's a fair question. Even if earlier also when we had 84 CD last quarter, the domestic was at 76, the international was much higher. In case you look this quarter, we have moderated the international growth substantially down, particularly in the asset side. So the current CD is 82 point something, which already we have shown there in the PPT. So our guidance now with regard, not guidance, but our range for operating the CD is between 80 to 82 going forward. So when I said 80 to 82, the bias again would be towards slightly towards 80 than 82. So that is what the normal we are looking to. But then again, when we construct the entire balance sheet in terms of both assets, liability, a lot of other moving parts therein, but then we'll try to operate within the band of 80 to 82.
Right. And so lastly on the margins, because we had a very sharp NIM improvement on the domestic book, like almost 22 basis point NIM recovery. So can we say that the NIMs have bottomed out? Any one-offs that we had this quarter? Any color around the same?
So that is what the CFO already outlined on the, if you look at the last quarter and this quarter, it is from 3.27 vis-a-vis 3.10. But if you normalize, it would be at 3.18. Yeah, am I correct?
3.15 for the quarter and full year also around the same level. So full year would be normalized 3-4 basis points lower than the full year 3.18. But for the quarter would be at 3.15 normalized versus 3.27 which is before.
So one thing that we discussed last time, typically we discuss much more on the margin side. And we announced to the market at that time saying that we reduce our bill deposit by 25,000 crore for the December quarter, although some increase in this quarter. So if you look at a policy scale, we are trying to slightly reduce the dependency on wholesale deposit to grow. That's a clear policy. That's why we said initially that I'm the calibrating on the advance growth vis-a-vis the growth in deposit. That is point one. Point two is a case where the liability book, which is a retail term deposit that I'm talking about, that's almost repriced in last quarter. I mean, if you look at the hike that happened and then normally the duration is 1 year. So these are typically all fully repriced. So the incremental impact because of raising deposit for fresh, rather the repricing would be positive going forward rather than negative. That is what my sense. So we think the margin as you are guiding is sustainable going forward.
Okay. Sure, sir. Thank you so much. All the best.
Thank you.
The next question is from Maruf Adajania. Please ask the question.
Yeah, hello, sir.
Hello, ma'am.
Hi. So, two questions. So, we had excess provisions as in that our wage hike assumptions were higher than the final settlement. So, how much was the write back? We can see some movement in employee expenses. I mean, not in provisions, but in employee expenses. But what was the actual write back on the provisions? And then what will be the run rate per month or per quarter of the non-actuarial employee expenses for the next year?
Yeah.
Maruf, in terms of the BAU wage areas, I think we were providing in line with the final hike that was around 17%. We were providing just marginally above that. So it's not that we were providing significantly above that. So when the wage settlement was made known in the last quarter, we were fully provided. So there's been no write back per se in that line. In terms of the retirements, as I had called out in earlier comments, we made additional provision on account of retirements on account of wage settlement for around 400 crores. In addition, there was a one-off increase in retirement provision on account of the discount rate coming down because bond yields are down in the March quarter. So totally on retirements, we've seen a 800 crore one-off increase in the quarter ended March. I hope that answers your question.
No, my question was that for FY25, what is the quarterly run rate of employee expenses that we should expect?
If you leave aside the 800 crore one-off increase, I think this is the run rate you can expect. So if you take your provision for retirements at around 800 crores plus what you're seeing in terms of employee expense, I think that's the run rate you can expect. So just reduce the cost of quarter 4 by 800 crores and that's your run rate.
Got it. That's very helpful. Also, would you comment on the agri slippage? Any seasonality there? I mean, usually the seasonality is in the first and the third quarter. So, or any geographic issue like in Punjab or anywhere? The agri slippage also rose QOQ along with MSME. So,
just to answer that, if you look at the normal slippage ratio, because the corporate slippage has been pretty low, right? So the average slippage is almost at 0.99 at this point of time, but couple of products wherein slippage would be higher, that is a normalized slippage. I don't think there is elevated slippage on the agriculture. So Lalsin, have anything that you can highlight on this?
So as far as agri slippage is concerned, during the year, it is 2,033 crores, and last year it was 2,100 crores.
Yeah.
But quarter on quarter, Q4 it is 917 crores, whereas the Q4 23 was 540 crores. So there is an increase of around 400 crores in the.
But on a yearly basis, this is almost.
Yearly basis, it is normalized. It is less than the last year.
Okay, fair.
The next question is from Rakesh Kumar. Please unmute yourself and ask the question.
Yeah, hi. Thanks a lot, sir. So couple of questions. Firstly, on this non-retail term deposit growth, which is at around 18.5% year on year, and now composition has reached to around 1/5 of the total domestic deposit. And if you look at CASA and retail TD growth is around 5.5% year on year, kind of 5.3%. So basically, like, if we anticipate this kind of growth, say in 25, then and looking at LDR of around 80-81%, how do we look at credit growth number? So should not we will have to depend more on wholesale TD number, considering that CASA and RTD growth is just around 5.5%.
No, that's why I said on particularly on the retail side and CASA, last 6 months we made concerted efforts to increase this book. If you look at CASA growth sequentially higher than the annual growth, so clearly the traction building off. In terms of product offering, both on the term deposit and we have differentiated large number of products. Where one bank having differentiated, like we came out with a product called SDP, which is equally like a SIP, which is a recurring deposit scheme. We are one of the bank along with another bank to offer the green deposit at this point of time. So there are multiple efforts going on, and you are right that we need to optimize on the retail deposit, no doubt about it. But going by the guidance that we have given, as you would have seen that last year also we raised almost 20 or 25,000 crore both in terms of the capital issuance and also on the infra fund. So there are areas where there is a possibility of getting refinance at a much cheaper cost. So there are areas where I can source my international deposit and convert and still get a margin. So there are multiple ways to support the credit growth. That's why I think again we said as a policy we want to reduce dependency on the bulk deposit. If you look at the June quarter and September quarter, the bulk was growing almost at 55-60%, whereas for December it was 10% and March it is 18%. So efforts are on to make not to have dependent on bulk deposit too much, but at the same time I think the guidance can be fully achievable within the LDR that we have announced of around 80-82.
Just one last question, sir. On the recovery side, basically NPA recovery and return of recovery, the number is now 8,600 crore, 70 crore, and previous year we had 13,400 crore number in the slide number 18. So there's quite a lot of drop is there, and we have seen in some of the other PSU banks also we have seen that NPA recovery number has been coming down, especially in the Q4 where it should have been a bump up actually. So how do we look at this number, NPA recovery plus TWO recovery in FY25? If you can help us with some guidance, would be very useful.
So I'll give a couple of comments and then I'll hand it over to Lal Singh Saab. One is that when you had a recovery, higher recovery last year, that was at an opening base of 1st April 2022. The NPA base was much larger as compared to the base we had for this year. The base we had for this year is around 54,000, which was much higher of 1st March 2022. So once the PT is going down, obviously the recovery would be less. There are a couple of, again, one-off in terms of last year recovery out of NCLT resolution. So this typically has behaved in terms of how do you look at the recovery last year and this year. As far as guidance, as against 12,000 crore of recovery guidance we had last year, we have announced to the market that 10,000 is the recovery target. At the same time, the trending of GNPA, NPA would be downward from the current level of 2.9 to, although we are not giving a guidance, but the trending would try to move towards 2.5. Similarly, the net NPA from the 0.68 to 0.5, but then we're not giving typical guidance whether it can happen in 6 month time or 1 year time. So clearly, see, if you compare my absolute number and also the level of GNPA, net NPA, these are comparable in the best in the industry. So I am not at an elevated level to reduce substantially. I've already achieved substantial progress in terms of creating a much better asset quality. So in that scenario, the incremental impact would be very less as compared to the earlier impact. So with the whatever recovery that you are talking about, we're in a position to achieve all this trending downwards kind of a GNPA and net NPA we're talking about. So we're quite hopeful of that. So Lal Singh sir, anything further you want to add?
No, thanks. You covered everything.
Okay. Thank you.
The next question is from Saurabh Kumar. Please unmute yourself and ask the question.
Hi, sir. The first one is essentially on this AFS. Can you quantify the capital impact? That's first. Secondly, what will be your expectation of, both the slippage and the recovery upgrade for next year? And the third is essentially on this core fee growth. You've obviously done very well this year. Do you think this 20% run rate is sustainable into next year? These are three ones. Thank you.
Yeah, AFS, you mean to say on the new guidelines impact?
Correct. Yeah.
So it's positive. I don't know if I shared the number or not, or otherwise you can share you offline with regard to this number. But then it's in money in the sense that there is going to be accretion in the reserve, a substantial amount, right? So that's one. Second is with regard to slippage and recovery. We said a recovery targeting of 10,000 crore. And we have an internal policy wherein the cash recovery, upgradation and recovery out of written off accounts has to be higher than the slippage. So obviously I'm targeting a slippage much lower than 10,000 for the year, right? And terminal level goes down. And third is core fee. When we have seen a core fee growth, particularly also to a large extent dependent on the liquidity scenario. If you look at the current liquidity scenario, it's possible to negotiate with customers, right? At the same time, we made structural change of creating a relationship vertical, whose job is to again mind the customer in terms of relationship, fee-based income and all those stuff. We have significantly improved our BCMS cash management service, wherein huge transaction flow business, fee we are generating. So I think it's sustainable unless and until there is the liquidity scenario tremendously changed from a current to a highly surplus zone, then there can be a change therein. Otherwise, I think it's sustainable. So anything on the AFS, Mr. Tyagi, want to add?
No, sir, I think you have covered it. Thank you.
Okay. Slippage recovery, Lavsins are broadly were in line, right? Okay. So thank you. Anything further from you? Otherwise, we're done with the question.
Thank you.
Thank you, everyone. That's the last question we'll be able to take today. Ian, can I request you to give the vote of thanks?
Thank you, everyone, and for attending our call. And this time, thankfully, our call has been on a working day. I think that's the feedback we got time and time again, that we should not keep it on a Saturday. So thank you, and look forward to, you can always write to us if you have any queries which are remained unanswered in today's call. Write to me personally. All of you have my email ID, or you can write to Investor Relations at Bank of Baroda. Thank you very much and have a great evening ahead.
So thanks all again for joining for today's conversation. Thank you all.